Testing. Topic 451, charitable and philanthropic contributions and deductions. So we're going to talk about what is a qualified charitable organization, what deduction limitations are there, what are the carryover periods, what happens with appreciated property, what are the non-deductible contributions, when do you need appraisals, and what are the substantiation requirements, and what can charitable contributions can be made by charity, the Red Cross, Salvation Army, Junior Achievement, and all kinds of other charities, including your church, have a maximum deduction of 50% of AGI. So this is what we would consider public charities. So the public charities are anything that is a 501c3, anything that you're giving to the government or the church, and it's defined by the IRS in IRC code section 501. So there's a chart in topic 43 about deductibility of various types of property, but contributions to public charities, the maximum deduction per year is a 50% of your AGI. Now, if you wanted to contribute to a private charity, the Smith Family Foundation, the maximum deduction is 30% of your AGI. And this is covered in private charities are the second group. It's still deductible and you can carry forward, but it's a max of 30%. Are limited but may be carried forward for the lesser of 5 years or death. An example, Lisa gives a charitable contribution carry forward. What is Lisa's carry forward if she gave $75,000 in cash to United Way and her AGI was $100,000? Well, if her AGI is $100,000, it's subject to the 50% threshold because this is a public charity. So $50,000. She gave $75,000, so she deducted $50,000 and carried forward $25,000. So things that are not deductible. So donations to non-charitable organizations, donations to your neighbor or a client, or to a client's neighbor because their house burned down, or a person at the end of the highway, or any of those things are not deductible. Donations when the donor receives something in return. For example, I donated $20, but I got a chicken dinner, or I donated to a golf tournament. The only amount deductible is anything that exceeds the value of the item that you received, whether that's meals or entertainment or golf or anything. So the only deductible amount in that is anything that exceeds the value of what you received. Donations to political candidates or campaign committees are never deductible, and donations to foreign charities are not deductible. However, if you donate to a U.S. charity doing work in a foreign country, that is deductible. So let's talk about donations of non-cash items, right? So when gifts of property are claimed as a deduction in excess of $5,000 and are not publicly traded stock or cash, a donor must obtain a qualified appraisal for each item donated and must include a copy of that appraisal with his or her tax return. So if I'm going to donate a piece of land, unimproved land, to my church or to my college, so the college is also a public charity. If I'm going to donate that, I must receive appraisal. If the donation is of non-publicly traded securities, you don't need an appraisal unless it exceeds $10,000. So this comes up a lot from individual tax clients. What is the substantiation requirement? For all gifts, cash or other property, over $250, a written acknowledgement from the charity is necessary to substantiate the contribution. So if I gave $200 weekly to my church, I could use a canceled check. But if I gave $250 or $300 weekly to my church, then I would need an acknowledgement letter from my church or any other public charity that I was giving to. If I'm donating clothes to Goodwill, you must attach an 8283 for non-cash contributions over $500. Not only do you need a receipt stating what you donated, but you must attach information. The 8283 provides where did you donate, what's the charity's name and address, what did you donate, how did you value that. So if I'm donating clothes to Goodwill, then I should use thrift store value, not fair market value or whatever I paid for the item, but thrift store value, which is considered fair market value of donated used clothing. If a taxpayer donates a vehicle worth $500 or more, the charity must report the gross proceeds on the sale of the vehicle to the taxpayer. The taxpayer will only be able to deduct this amount, the proceeds, on his or her return. Let's just say I donate a vehicle which has a fair market value of $3,000, but the charity goes and sells it and they only get $1,000. I can't have my basis or the fair market value. It's only the proceeds. Now, this is different if the charity actually uses the vehicle rather than selling the vehicle. If they use the vehicle, then I can donate either the fair market value, I can use the fair market value or my basis in the property. There's more information in the chapter about whether you're donating the fair market value, or the limits to that. So, for example, if you're donating to a charity property, you have a choice. You can either use, let's just say Wilma White has adjusted gross income of $100,000 for the year. She has stock owned that she's owned for several years with a basis of $60,000 and a fair market value of $70,000. Wilma decides to donate the stock to her church, which is a qualified public charity. She can either choose to value the stock at fair market value, which was $70,000, and with a deduction limit of 30% of AGI, and she can carry forward the remaining amount, which means she can deduct $30,000 in the current year and carry forward 40. Or she can value the stock at basis and deduct 50%, which means it was $60,000 was her basis, so she can deduct up to 50 this year, but there's $10,000 to carry forward. So when the basis and the fair market value are similar, the 50% for the basis seems to work out. But if they weren't similar, you're losing a big portion of your deduction if your fair market value is significantly higher. So let's talk about the direct contribution from an IRA. So the Protecting Americans from Tax Hikes, or PATH Act of 2015, made charitable contribution distributions from an IRA a permanent tax advantage for taxpayers 70 and a half years old or older. They may contribute up to $100,000 directly from an IRA to a charity. Now remember, IRAs, traditional IRAs, require taxpayers over 70 and a half to take required distributions. So this amount counts as a required distribution. So if they're taking required distribution, they don't have to count that money as income, and they can pass it directly to the charity. You don't deduct this on a Schedule A because you're not including any of this distribution in your income. Therefore, the 100% up to $100,000 of the distribution is being excluded from income. So this is a great advantage for people who don't need the money but have required distributions that they need to take but would like to give that to a charity. So now, talking about business charitable contributions, C Corps may deduct up to 10% of taxable income. In excess contributions may be carried forward 5 years. When a charitable contribution is made that is directly related to the donor's business, the cost must be taken as a business deduction rather than a charitable contribution. And also remember, if you're donating through a partnership, these are separately stated items that would go directly to the partners based on their ownership percentage. So if I was in a partnership that I owned 10%, they donated $100,000, I get $10,000 of that based on my 10% ownership. That would go on my Schedule A, and I can use that assuming I exceed my standard deduction. Then the charitable contributions become deductible. So this is just an overview of how charitable contributions and philanthropic plans come into tax planning.